Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the corporate world without losing our minds, and today we are diving into Scholastic Corporation's quarterly report. You know, the book fair people, get ready because this filing has some juicy financial moves and a massive real estate deal that changes things up. Also, before we jump in, if you love getting these unfiltered looks behind the corporate curtain, make sure you are subscribed and join our Discord community, link in the description below. Scholastic Corporation is out with its latest quarterly report and it looks like they've been busy. For the period ending February 2026, they shared a lot of numbers. We're going to skip the legal jargon and get straight to the core of this report, the actual financial performance and what it means for the company. Let's dive right into the heart of it with their income statement. For the 3 months ending February 2026, Scholastic brought in $329.1 million in revenue. That is a slight dip compared to the same time last year when they made $335.4 million. But here is where it gets interesting. While revenue went down a bit, their net income shot up an incredible $62.5 million. Compare that to a loss of $3.6 million for the same period last year. That is a massive swing, and for the 9 months ending February 2026, their revenue was $1,105.8 million, down slightly from $1,117.2 million last year. However, their net income this year is $47.3 million. A huge jump from a loss of $17.3 million last year. So even with slightly less sales, they are making a whole lot more money. How is that happening? Well, a big part of that story is this gain on sale and leaseback transactions. They reported a gain of $119.8 million for the quarter and $118.2 million for the 9 months. This means they sold some significant assets like their headquarters in New York City and their distribution center in Jefferson City, Missouri, and then leased them back. Think of it like selling your house, but continuing to live in it, getting a big cash injection in the process. This sale and leaseback really boosted their profits for this period, making the bottom line look very attractive. Now, let's look at their balance sheet to see how things stack up. As of February 2026, their total assets were $1,780.8 million. That is down from $1,950.1 million in May 2025. A big reason for this drop is likely that sale we just talked about. Their property, plant, and equipment dropped significantly, which makes sense if they sold those major facilities. On the flip side, their liabilities also decreased, especially long-term debt, which is a positive sign. Stockholders' equity is pretty solid, ending at $871.9 million. Looking at their current assets, accounts receivable is $248.3 million. Inventories are at $282.5 million. These are significant amounts, but it is typical for a company that sells physical goods. The key is how well they manage these and turn them into cash. Now for the cash flow statement, which tells us where the money is actually coming from and going. For the 9 months ending February 2026, cash used in operating activities was $39.1 million. This is a notable increase in cash used compared to last year when they actually saw $17.3 million provided by operating activities. They attribute this largely to higher tax payments, partly due to that gain on the sale and leaseback, and some other contributions and payments. But then, investing activities show a massive inflow of $406 million. This is mainly from that big sale and leaseback, which brought in $452.4 million. This influx of cash is what is really shaping their financial picture right now. Financing activities show a significant cash outflow of $386.9 million. This is largely due to repaying debt, but also a substantial $127.2 million spent on repurchasing their own stock. This shows they are returning value to shareholders, which can be a good sign if done strategically. Scholastic breaks down its business into 4 main parts: children's book publishing and distribution, education solutions, entertainment, and international. For the 3 months ending February 2026, children's book publishing and distribution made $197.6 million, while education solutions brought in $56.1 million. Entertainment, which now includes the acquired 9-story operations, generated $16 million. The international segment chipped in $58.7 million. Looking at the quarterly revenue by segment, children's book publishing and distribution saw a small decrease of $5.7 million. Education solutions also saw a slight dip of $1.1 million, showing they are still facing challenges in the school funding market. Entertainment, however, did show growth, increasing revenues by $3.2 million. Likely thanks to those new production activities, international revenues, despite a small stated decrease, actually saw a favourable foreign exchange impact, which is good news. Something to note here are the asset impairments. For the 9 months ending February 2026, they recorded $9.4 million in asset impairments. This means they wrote down the value of certain assets because they were no longer recoverable. For example, they took a hit on some education products that are no longer being sold, and also some film and television programs in development. This shows a cleansing of their books, writing off assets that aren't performing as expected. On the debt front, Scholastic has a $400 million unsecured revolving credit facility. As of February 2026, they had no outstanding borrowings on this facility. This is a really strong position to be in. It means they have access to a large amount of money if they need it, but they aren't currently paying interest on it. They also have other credit lines. But the key takeaway is that their primary borrowing capacity is unused, which suggests good financial health and flexibility. They are actively repurchasing their own stock. In the 3 months ending February 2026, they bought back almost 4 million shares, spending over $130 million. This shows confidence from management in the company's value and a way to return profits to shareholders. Now let's talk about that massive sale and leaseback. On the 17th of December 2025, they sold their New York City headquarters for $386 million and their distribution facility for $95 million. That is a total of $481 million in cash. They then leased these properties back. This wasn't just a way to get cash. They've recognized a significant pre-tax gain of $118.2 million from this deal. This strategic move has clearly bolstered their financial position, allowing them to pay down debt and invest in other areas. The management discussion section paints a picture of a company navigating a shifting landscape. They highlight the shift in revenue timing for their popular Dogman series, which impacts quarterly results, but they expect strong performance in the fourth quarter. They are also seeing strength in their school reading events and international markets, while acknowledging ongoing challenges in education solutions due to school funding. The entertainment segment is expanding its pipeline, which could be a future growth engine. Within their core children's book publishing and distribution segment, revenues saw a slight decrease due to timing of certain book releases. However, their book fairs and book clubs are showing resilience with higher revenue per FAIR and stable redemptions of incentive credits. This indicates their core business. The one most people know them for is holding its own. The Education Solutions segment continues to feel the pinch of school budget constraints with revenues down. However, management notes that their lower cost structure is helping to improve profitability within this segment, which is a smart move given the market conditions. The entertainment segment, boosted by the 9-Story acquisition, is expanding its media development pipeline. While revenues for the 9-month period were slightly down, the company sees this segment as a key growth area as industry activity picks up. Internationally, revenues have been impacted by foreign currency fluctuations and the timing of book releases abroad. However, sales in key markets like Australia and the UK are showing positive signs, and the company is focusing on growth and margin improvement in these regions. Looking at liquidity, Scholastic has $104.6 million in cash and cash equivalents. While cash used in operations increased this period, the massive influx from the sale and leaseback transactions provides a strong safety net. They have ample credit facilities available and are actively repurchasing shares, indicating a strategic approach to managing their capital. Now, let's put on our Warren Buffett hat and look at the bigger picture. Scholastic is in an interesting position. The sale and leaseback of their major properties was a brilliant financial move, significantly boosting their cash reserves and bottom line for this period. It allowed them to pay down debt and signal confidence through stock buybacks. However, relying on asset sales for profit isn't a long-term strategy, and the core business revenue is showing some softness, particularly in education. The children's book market, while iconic for Scholastic, is competitive and subject to shifts in publishing trends and school funding. Their entertainment segment, especially with the recent acquisition, holds potential for future growth, but it is still a smaller piece of the puzzle. The international segment shows promise, but is also exposed to currency risks and global economic factors. What are the risks? The continued reliance on school budgets for their education solutions. Segment is a vulnerability. Any major downturn in school spending could significantly impact that division. Also, while they bought back stock, it is crucial they are not overpaying for these shares, which could signal less attractive future returns. The narrative of improved profitability driven by a sale of core assets rather than organic growth needs attention. On the opportunity side, fully integrating and leveraging the 9-Story acquisition in their entertainment division could unlock significant new revenue streams through content production and licensing. Their established brands and distribution channels in children's books also provide a strong foundation. In conclusion, Scholastic is in a phase of financial transition. They've executed a strong deal with the sale and leaseback, which creates immediate financial strength. The real test will be how they leverage this capital to drive sustainable organic growth across all their segments, especially in entertainment and their core publishing business. While navigating the challenges in education, they've shown they can be smart financially. Now they need to show they can be smart strategically for long-term success. Alright? That is our breakdown of Scholastic's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives, and don't forget to check out our Discord community in the description for more real-time discussions. Thanks for watching. See you next time.